Say on streets.
Our streets.
Say on streets. And main it.
Right.
Main it. Whose streets?
Our streets.
Word on the beat, word on the beat, word on the beat.
Time after time after time after time after time after
What up? It's your boy Bass. And y'all are tuned in to another episode of Ian's Podcast. Today, man, we're going to be talking about that money. And today's topic is really going to be about covering dividends. Yes, we're talking about the stock market, investing, but we're going to be covering over what is dividends, how you can use that as a strategy when it comes down to investing into stocks, and why would you use that as a strategy. And I'm gonna also give you access to a tool that I use. They also got a free version, but then they also, as y'all see, you can unlock all the benefits for $1. We'll get more into that on this, on today's episode. So we're gonna kick it straight off. I got my list pulled up. These are all current stocks that I'm invested into. But what we want to talk about particularly, before we even get to looking at this list, I want to talk to you about dividends. Like, what is dividends? Dividends is a sum of money paid regularly, typically quarterly, by companies to its shareholders out of its profits or reserves. So when you invest in the stocks, a lot of times you will see, I don't know what platform you use, but a lot of times they had the dividend yield percentage, or they might also have like around the area where they have like stock price, market cap, things of that nature. So as y'all look on this watch list that we have here, shout out to finbox.com. I use them to watch my watch list and keep track of my dividends per share. So as you see, some of the companies I invested in, majority of companies I invested in, they pay out dividends. Now this is a strategy, because when you're investing for dividends, you're investing for the long haul, which means, long term. These are companies that steadily increase or have been around for a long period of time. A lot of times you would like to know their business too, so you can just get an honest understanding of when their business is changing and staying up to date. Because the one thing about this type of strategy, I'm gonna let you know the bad first. So I'm gonna tell you the bad news first. The bad news when it comes down to choosing stocks based off of dividends do change. Some companies change their payout or just take it away completely, depending on how bad the market is doing. For example, Wells Fargo has a very good payout, but when the crisis had hit, they had to take that dividends also got hit. So depending on the situation, sometimes the dividends take a hit. Sometimes companies choose not to, they choose not to mess with the dividends percentages or anything of that nature, just due to, just keeping a relationship with their shareholders. But when it come down to like just building a portfolio, one of the main strategies that I went for, especially with when I started thinking about like long term, was going after companies that pay out dividends. Now the dividends, depending on the industry and the company, can be, as what you heard, quarterly, annually, or sometimes monthly. There are certain stocks like that pay out monthly, but a lot of them pay out quarterly. So in this column right here, where you see, for y'all that can't see, there's a column on Finbox that says dividends per share. So dividends per share, for example, have Apple Apple's on the top of the list. Their dividends per share is $3. That's paid out quarterly. And then with that, you can start to factor in how long it would take for you to either make your money back. But if you're not doing it to just make your money back, you're doing it to just build capital money from your dividends, then you can start, putting together a separate account. I use Robinhood. I don't know exactly what y'all may use. Everybody is, different strokes for different folks, but I currently use the Robinhood account, and it keeps you up to date with upcoming earnings, like companies that are doing it, upcoming payouts. Keeps you up to date with voting, when like you have an understanding of when you're going to be able to vote on certain key issue, like key topics that's going on within the company, things of that nature. But that just kind of going into some of the features, but going back into dividends. So part of the strategy is building a portfolio where I'm getting paid dividends from the companies that I'm invested into. So no matter what, especially if I'm investing into them for the long haul, that there's going to be ups and downs. The stock market is very it's like, I don't know what you call it, have mood swings, flip floppy. It's good one day, it can be bad the next day. But the one thing that can, constantly stay the same, that if this company is steady doing business and, seeing a steady increase, they will most likely pay you out and with some type of dividends, and you can kind of build some type of, type of forecast what your dividend payouts will be like. But like I said, these things do change because you do have companies, say like, your Apples, for example, or different companies where they make a lot of money and then they pay you extra, or they raise the dividends. These things can change, and you will appreciate that a lot. But then that's one of the perks. So we went into one of the cons of investing into stock based upon dividends, and then now we're going to one of the perks, and that is one of the perks. Depend on how good a company do. Sometimes those dividends change, the increases, or sometimes they pay out like bonuses. I don't know what the exact term is, but it's sort of like a bonus where they give you like extra, basically for being shareholders within their company. So once you start to see like some of these stocks that I'm invested in, such as Ford do 60 cents per share. Now I bought a Ford share for I bought in at $4.30 something cent. I do believe it was like $4.30 something cent. And then I was just looking at like over a year, I would probably make 60 cents. I make 20 cent off of these. I make 20 cents quarterly off of these shares, and then over a year I'll make 60 cents. So then I started doing the numbers, like how long that'll take for me to make my money back, and then I start looking at just the overall growth of the actual stock and how the stock is doing. Just long story short, and just me just being from Detroit, I kind of had, some emotional attachment to investing into, the motor industry, because I'm just well tapped into it from family that worked there and stuff like that. And just from, growing up there, you have an understanding of how these companies work and their structures and their processes, and just being aware of what's going on firsthand. And then you will see another one was Fiat Chrysler, but Fiat Chrysler dividends is a little higher, but also the buy-in is also higher as well. But their dividend is around close to 80 cent, but it's at 77 cent annually, and then they divide that up into different quarters payouts. But one of the key I ain't even gonna say key, but one of the steals that I got was investing into this real estate company. Hold on, hopefully I can find them on here real fast. Was invested into this real estate company. It was New York Mortgage Trust. I'm trying to see, did I add them to the list? No, I didn't add them to the list, but we're gonna go ahead and look them up real fast. So one of my big reasons for really getting into like New York Mortgage Trust was just getting into well, I didn't really understand it at that time. I had a basis like to go off of, but I didn't really have a full understanding of what I was getting myself into. Hold on, I'm having a hard time pull it up. But in the meantime, if I can't find that one, then we'll just pull up the new residential stock. They both fall under the same category, but the other one was just cheaper. But I ended up buying in at the New York Mortgage Trust at $1.18. And then over the last 3 weeks, the price went up to about $3.50. So I probably own, like, I ain't gonna say how many shares, but I own a good number of shares of that company. So for each share, I made like $2 off of. And then on top of that, because we're buying in at $1, $1.18, you make dividends. I want to say it was quarterly dividends. The quarterly dividends was 20 cents. I do want to say it was roughly around 20 cents, somewhere around that. I could be wrong, but but it was just that when looking at it, it was the dividends compared to how much I bought in at. Like, I will make my money back fast, but then also the increase, like the stock went up since I bought it. So I already doubled my money just off of just the stock value alone. Now, when you start incorporating the dividends that I make off of it, I can either take those dividends and reinvest it, or I can just let those dividends stock up. And even though those dividends, in a sense, it's like, but now you can kind of, I made more off the stock going up, but then also made enough, I'm making my money back off of my initial investment too. So it's like you pretty much I'm profiting more. You feel me? Like, I feel like I'm just profiting a lot off this just certain type of stock. And that was the New York Mortgage Trust, and that was because I bought in at $1, but then the dividends was like 60 cents annually. You had like 60 cents annually dividends. So it's like in 2 years, if everything, if it just go at a steady pace, in 2 years, I will make that money back, which is pretty cool. If you think about it, just off of investing $1. But then what I was saying also too, with just how the stock was just doing, I already didn't make that money back like 200% because it didn't went up $3, like $3 and some change per share. And it's fluctuating. It's probably going back down. But the one I have pulled up right now is New Residential Investment Corp. It's another one of those stocks that you would say is like, for $5. Something small. But about this company is a real estate investment trust focused on investing in and managing residential mortgage related assets in the United States. It operates in the origin services, MSR related investments, residential security loans and consumer loan segments, company investments, assets, mortgage, servicing rights, and residential mortgage loans, et cetera, securities, and just keep going along. Basically, they have a big portfolio within the residential in the United States to a certain extent, but then also in other places too. And that's not their only thing is residential. As you see, they deal with loans and more. But the reason I clicked on them was to go into the actual dividends. I don't know how I actually got on there, but for y'all that's listening, let's actually go into the dividends. Let it load up. Or bump that. We just gonna go into so I get the MFA Financial. MFA Financial is another one of those company too that I also bought into. I bought the shares at $1. This one said $1.62. That's what the current price is. The current price is at, let's go back up to it. at $1.68, but their dividends is at 80 cents annually. So think about that. That means it's a risk, just going into what the company is, but we're not talking about the actual company. That goes into more of you doing your own research, identifying what makes that company tick, but just understanding what the strategy is. paid $1.68 per share. The dividends payout is 80 cents annually. So within 2 years, I will make just about the money back that I initially invested. So not to mention that if this stock also increases, I make money from that as well. So that was just looking at the strategy that I was just going after. But then I'm not looking to sell, so I'm just looking just to bring in the dividends. So this is something small, but it's like, you can keep reinvesting because it's at a smaller price. And then also the dividends. So them shares start to add up. Excuse me. Those shares start to add up, like long term. So, and then those dividend payouts also start to add up. But then you start to see that you recoup your initial investment. You could recoup your initial investment in a good timely manner, just based off of dividends. And then long term, you can just keep raking in that money from those dividends. But then that's a small investment. But just as a little bonus, we are kind of going to what is MFA Financial. Through its subsidiaries, they operate as a real estate investment trust, also as well known as a REIT. The company invests in residential mortgages, mortgage assets, including non-agency mortgage-backed securities, agencies, MBSs, and credit risk transfer securities, residential whole loans, including purchase performing loans, etc., etc. I ain't gonna go into too much detail because, like I said, it's always better if you also do your own research. But then you see in the 52-week range, this was at its lowest 32 cents, but at its highest $8.09, and I bought in at $1.68. So it's still at its low. It has not reached like last year high, over the previous year high yet, or even anywhere around that mark. But if it does go up to even $5, think about how much money I already made back off of that. But that's just if everything goes well. But the stock market is the stock market. But it says the average price of this is $7.39, and I bought in at $1.68. They say that the upside is 339.9%, but the uncertainty, because it is the real estate market, and this stock is basically, their portfolio is based off the actual real estate market, the uncertainty is very high. This is all based off of people's behavior. So going back into that's why I say also do your research so you can stay up to date with what's going on in the real estate market and see what is going on. So you can see how I'm like watching and playing the stocks, but understanding dividends, it kind of plays to the whole investing. Then it kind of teaches you to kind of exercise researching and learning about these different businesses and different business industries. So you can start to figure out, like, all right, is it worth investing into for the long term, especially if you're doing what we are talking about, going like the dividend strategy, which you're basically going after dividend growth. Because with some of these companies, like what we were just saying, if you can make your money back within 2 years, some people sometimes reinvest those dividends as well. And then if we go back to the actual watch list, now I'm not gonna be no big capper on here. I don't even say cap like that for real. But I'm just not gonna perp or nothing like that. Like when you see Berkshire Hathaway, yes, I own fractional shares within Berkshire Hathaway. But this is all. But I'm just saying that Berkshire Hathaway does not give out dividends currently. But I was just saying that because when you see him on my watch list, you see what the price of Berkshire Hathaway is. You're probably thinking like, damn, he spent hundreds of thousands on a share of stock. No. Nowadays, these platforms offer what they call fractional shares, which means you just put in your amount, and then they, based off your amount, they give you back, you buy a percentage, a fraction of that share based on what you put into it at that buying cost. You feel me? So if you ain't really catch that, it's like they lock in the number at where it's set at. You know, with the stock market, when we be having all the numbers going in, they lock in that number. So when you buy it in at that number, say if you put $10, they gonna do what is that? You know, what is the amount? What is $10 out of 236,000? You feel me? Or what is $100? Or what is $40? Or what is whatever you got? Like that's why it's really, especially like for millennials, they didn't really change the game for us to really try to accommodate for us, because they know a lot of us, we don't really got that knowledge or that awareness. We just not really aware of what the stock market does, so we're less reluctant to go into it. And a lot of us in debt too. So at the same time, they're trying to figure out, you feel me, how do they get more money into it. And I peeped the strategy of how they do fractional stocks, but it's just more so of how do we, take advantage of that. So that's where I did with some of these companies, such as when like you see like Berkshire Hathaway, or when I invest into like companies like Amazon, and even Google. Those are thousands of dollars for stocks. At this given point in time, it's ends. I'm keep it all the way 100 with you. It's ends. Make the most out of your current circumstance. That's eating in the streets. Ends me eating in the streets me making the most out of your current circumstance. So if you only have $5, well, but you got Android this, Android that, you got a Chromebook, which I'm talking about myself. I got Android phones, Chromebook, I use Google, everything basically. So why not invest into what I'm currently using? You feel me? But then it was like back then, just looking at it like, damn, how am I investing to that if it's $1,300? You feel me? I ain't about to just spend no $1,300 on no stock. You feel me? So when they introduced the whole fractional shares, and once I actually learned about it, because I was a little skeptical about it too, because I'm like, fractional shares, so I don't really own it. I'm just kind of like, what it is, like do I actually even get dividends off of it? No, it's like you actually really do get dividends off of it, but they divide it up based off of that fraction of what you own, so you get that percentage of what that dividends will actually be. So that just going into fractional shares and how that relates into dividends. You still get, based off that fractional share purchase, whatever that fractional share may be, it could be 0.000001. You are going to get 0.00001 percentage of whatever that dividend payout will be. So, like I said, you got to be able to do the math on that one. So yeah, it's like even for what we was talking about, even with Tesla, Tesla stock is actually going down, but Tesla don't pay out dividends either. I'm just saying, because Tesla is $700. I bought in with that fractional, you feel me, fractional shares. But I don't want to get too far off topic. We're gonna keep it on dividends. So if you for those that are not looking, you can see that majority of my portfolio is made up of companies that pay out dividends in various sums, ranging from, the Boeing company, Boeing Jets, that's because they pay out a dividend of $8.22. But the buy-in cost is $1.33. But like I said, depending on what your situation is, I said $1.33, $100.33, like $133.37. But for you, no matter what your situation is, maybe you only got $3 on you, like, just think about, like, whatever your situation might be, you feel me, you can invest into, like, a stock like that. Now, you won't get that $8 back. Like, you would get the percentage, like what we were talking about. You would get whatever that whatever the value is that you got out of that. Like, so I don't know, whatever you put up, just to say like if you got 0.006 or 0.06 percent of a share, or that's how much of a share you own, is you own 0.06 of a share. So then that's what your dividends is going to come out to, like how much is that valued in dividends, if that much ownership. So that's just something to think about when you start thinking about investing. You start thinking about long term, and you start thinking about different strategies and where to move around and put your money in places. Now, one thing that I will shed a little light on is that these are taxed. Now, different stocks are taxed differently. We're going to cover that in a different episode. You feel me? But I just want to get your brain start thinking. You feel me? So what we was talking about when we was talking about that REIT companies, which is like real estate, like the real estate investment trust companies. Those type of companies, the way that they're structured, you feel me, you are paying like consumers tax on those versus when you are paying like, ownership tax, stock, like paying like taxes on Ford versus paying taxes on New York Mortgage Trust or not even New York Mortgage Trust or MFA Financial or New Residential Investment. Those are a little bit different than paying the taxes on Series XM Holding Company. Now, as y'all see, also, we bought into Series XM. They did pay out dividends. That's the reason why also too. But their dividends is like real low. It's 5 cents, which is pretty cool. But another reason was because Sirius own Pandora and N's Radio is on Pandora. So why not? You feel me? Why not, man? Why not? And if you're gonna give a little dividends, you're gonna give me a few cents for doing it too, then might as well. So just in case, y'all don't listen to the actual podcast, you can still make some little couple cents off these, somewhere off that platform. But we ain't gonna talk your ear up a little bit too much. I love to get feedback from, some strategies that y'all use. How do y'all feel about dividends? Is it anything that y'all would like for me to cover over that, or how has your process been going with that, or how do you feel about it? It's your boy Bass. Y'all tuned in the Ends podcast, and we about to get tuned out. Peace.